Hi, it's Connie from Prosperity Finance, sharing the best financial tips so that you can be more successful with achieving your financial goals. Now, over the last few days, we are bombarded with a lot of inquiries about interest rates. You probably heard already that some bank has dropped the rates to really low, like 2.79%. It's unbelievable. But some banks still, keep at 2.99%, etc. So people really confused. And we got questions like, what should I do? Shall I refinance to another bank who offer lower rates? Or some question like, I'm on a higher rates. Should I break my current loan term and relock it at lower rates? Or people ask, what should I do? My loan is coming off fixed term. Should I wait for the rates to go even further, or should I lock it now? So there's a lot of a question around. There's a lot of a confusion around. So I thought it's a really good timing to do a video on the interest rate, so that hopefully help you to clarify these questions. So first of all, let's answer the first question. If you are on a higher interest rate now, should you break the rates and relock it at lower rates? Well, it's simply a calculation of the cost and savings if you break it and lock it at lower rates. Now, the cost is called break cost. It's a true cost that the bank need to pass to you, because you break the contract, they charge you at the moment at higher rates, and now you want them to charge you at lower rates. So they suffer a loss and they need to pass it to you. However, it's still worth doing if you think the saving is more than the cost. So it's a matter of calculation, both figures, and we can help you to do that. For the break cost, that figure need to come from the bank. We can't simply calculate ourselves. You can ask the bank yourself and let us know, and we help you to work out the difference, or we can ask on your behalf, as long as you sign a declaration form to give us the authority to inquire. And then we'll simply present the difference and let you know maybe it's worthwhile breaking or not. But to be honest, what we've seen for so long is that the break cost is probably equivalent to the interest saving anyway. So there's probably not much point of breaking it. And so if so, you probably just keep it simple. Just let it finish its own fixed term. Now, you may feel regret that you lock at lower rates. The truth is, you can't always win. We can't sometimes predict that the rates drop even further. There's no warning sign, etc. And also, on the other hand, it's really about how you manage repayment. So interest rate is just one side of the equation, but also how you repay the loan is equally important. If you relock at a lower rates, but then you only pay the minimum when you have a lot of cash flow surplus every month, it's probably not a good idea. So it's about rates and repayments. So if you can manage repayment well, it's actually also help you to save interest costs in the long run. Now, you can consider break the loan and fix at lower rates, even though the break cost is pretty much the same as a saving. There is one benefit potentially is you potentially can increase your borrowing capacity for the future. Well, the reason being is when the bank assesses your future borrowing capacity, they will look at what is your existing loan structure. Now, your current repayment and your rates actually have an impact on your future borrowing capacity. The lower the rates, the less the repayment, the better. Apply to some banks like ASB, Westpac, Bank of China, etc. So they're looking at your current payments and your current rates, and then they'll work out future borrowing capacity. So it maybe it's still a good idea to break it, even in terms of the saving, it's probably not much, but potentially increase your borrowing capacity dramatically. So that could be one reason for breaking it. Also, in terms of people asking me if you should refinance or not. I would say sometimes refinancing it help you to recover some of the cost because you potentially get cash back. Despite there will be a solicitor fee involved when you do the refinance, probably still worthwhile when you have a large loan. However, just bear in mind there could be a couple of pitfalls. Number one is if you sign a cashback agreement with the bank, we call it DOA, then you have to pay back some of the cashback you received if you exit early. This period could be 3 years, could be 4 years, depends which bank we talk about. That could be a potential cost for you. Also, you have to bear in mind some of the product features and loan structure that you have with existing lender. If you refinance, you potentially lose that. So it's best to look at kind of take a holistic approach normally, you need to get some expert advice in terms of considering refinancing. Make sure that you take into account all the factors, so you're not just only save a bit of cost, but also take care of other aspect of your loan. So that's about people looking for refinancing. So that's the first question. Let's move on to the second. Second question is, if you just book the rates, you sign a lock rate agreement, but you haven't really roll over the rates. That means your current loan hasn't expired, but you have booked the rates. So most of the time, it's probably worthwhile, pay a set of fee to break that lock rate agreement, because that fee is kind of a flat fee. It's not like a break cost that we mentioned in the question 1. That's actually driven by a lot of other factors, like your loan amounts and how long the remaining loan term, etc. And the rates different between the time you fix and the current rates. Whereas just cancel a relock agreement. It's relatively kind of fixed fee, but on the other hand, you potentially save a lot of money. So probably worth considering doing that. Again, we can help you to figure out the cost and saving for you. So that's the second question. Now, the next question relates to people whose loan is coming off fixed term. And then, what you should do. Should you just lock it now, or should you wait for the rates to drop even further? Well, I would say it's quite likely the rates will go downwards in the near future. And even some commentators say the OCR, the official cash rate, may go into negative early next year. So a lot of things indicate the rates could drop even further. But I think no one knows how quickly the rates could drop, even further. So if you just keep waiting and let you loan on a floating rate, probably it costs you more down the track. So I would say, if your loan still got at least 2 or 3 weeks until expiry date, then wait to that period. Then you need to make a decision. If the bank hasn't really dropped the rates, I would say lock for 1 year is probably give you the best value. 1 year is really short term. You can refix at lower rates once the 1 year is up. So you can still enjoy the benefit of lower rates. You can't win every time. At least give yourself 2 weeks window, because it takes that amount of time for the bank to action your request, to give you the rates action request and reissue a letter, etc. So don't leave to the last day. Your loan can't be refixed just on the day of expire. So please give yourself at least 2 weeks and then consider what you want to do. Floating, in my view, is not a good idea. Okay. If your loan is large and you want some certainty, it's best to have a mix of 1 year and a longer period fixed term, such as 18 months or 2 years, depends which is lower. You just want to have them coming out fixed term at a different time. if you can do 18 months at the same rate as 2 years, I'll go with 18 months because then, give you more flexibility, time to refix at lower rates early. So that's why I said, if you want certainty and low rates, split your loan into the 1 year and 18 months or 2 years the most. I don't see any value going to really, really long term unless you have a specific reason, like you have huge loan and all you want is certainty. You don't really care, the cost. So yeah, that's about my recommendation in terms of how long you should fix for. Again, I want to emphasize on the repayment. It's equally important. I see people repay, way beyond the minimum. Yes, you can pay that faster, but then economic downturn, like if you want to extend your loan term and reduce the repayments, it's the bank need to reassess you, so you actually has no room for yourself to make adjustment. Now, on the other hand, I see people just pay the minimum, even interest only on all the loans, but they have a lot of surplus cash putting aside. It's kind of waste the money because you potentially pay much more interest down the track. So repayment is really important. And need to take into account your personal situation and make sure you have a good balance. There's one more question here. So if you can lock at the lower rates, how you set the repayment. Now, you have two options. One, you keep paying the same. That means you could pay off your loan faster by reducing your loan term. Alternatively, you will reduce the repayment because the rate has dropped, so you keep the same loan term but pay less. Well, each has the pros and cons. If you reduce the payments, that means you have more cash in hand every month or every week. Then you can use that extra cash to build some buffer for rainy days like COVID-19. You could also use that to purchase some essential items. So that's a benefit. But if you pay the same payment as before, the benefits, obviously, you pay off the loan faster, but you may not have the surplus cash for the rainy days, and also potentially will compromise your future borrowing capacity because your commitment is higher than otherwise. So just have to bear in mind the pros and cons. There's no right or wrong. It really depends your situation and your goal going forward. So unfortunately, for each question, there's pretty much no kind of one-size-fits-all answer. It really depends your situation, your goals. This is the time that you really need an expert to help you navigate all the options, because your situation could be different from others. So understand the principle behind these, but more importantly, you need to adapt your own situation. Now, that's all from me for this video. I hope you find it useful. If you like my video, please feel free to subscribe our YouTube channel, because every week we have a great content to share with you. Thank you so much for watching. I will see you in the next episode. Bye-bye.